the annual banking conference. To start with our first panel discussion for the day on the topic, FinTech Evolution, Balancing Innovation and Risk Management. It's my privilege to invite on dais the panel of speakers, Mr. Anubrata Viswas, MD and CEO, Airtel Payment Banks, Mr. Rajiv Ahuja, ED, RBL Bank, Mr. M.N. Srinivasu, co-founder BillDesk, Madam Nupur Chaturvedi, CEO, NPCI Bharat Bill Pay, Mr. Adil Shetty, founder and CEO, Bank Bazaar, Mr. Rajesh Kini, CFO, Perfios, and our moderator for this session is Mr. Vivek Mandata, MD and partner, BCG. And I would like to invite Mr. B. Krishna Chaitanya, Senior Vice President, Product, Perfios. I request Mr. Vivek to initiate the discussion. Over to you, sir.
Thank you. Good morning, everyone. First of all, very good morning to all my fellow panelists on the stage. We have a very interesting topic to debate, deliberate, and discuss. The fintech ecosystem over the last 5-6 years has really become part of financial services, I would say, an integral part of financial services. A lot of innovation, a lot of, I would say, contribution in partnership with incumbents, a lot of it separately done by them. And cumulatively, they've added a lot of value to the ecosystem, right? So today we speak about how fintechs, a lot of them together are valued at about $100 billion. That's a significant value in that fintech ecosystem. At the same time, we've seen a lot of evolution as well of how fintechs have evolved. The ecosystem has understood how to interact with fintechs, and fintechs have understood how they can interact with the ecosystem. So let us kick it off with, an introductory remarks maybe from all of you. I'll start with you, Rajiv, on as a large bank who's seen this play out, right, from the beginning. How have you seen this ecosystem evolve from where we began to now, the maturity in sticking to the topic of compliance and innovation, right? How do you see the maturity evolving?
Thanks, Vivek, and thank you for having us here. I've now been on several panels over the years, and I can tell you that the impression one gets that what started with us at least 10 years ago, 2014, when we really started engaging with the fintech ecosystem to today, the relevance, the size, scale, as you mentioned, is very, very important for the industry, as also is the learning which has been now reinforced on the need to maintain a certain level of governance, compliance. And the tenets of this is something which banks and other regulated entities have been following for years. So, when I look at it, customer service, data ownership, which is going to become a very critical part. And I think what we are seeing is that maturity curve has become a lot more easier to deal with. 5-7 years ago, it was all about, hey, why should I do what you're doing as a bank? Because I'm here to displace you. But I think those starting positions are a lot more mellow. I think as long as the fintech and bank partnerships evolve on the basis of the tenets of customer protection and increasing customer services, I think this thing can be addressed, and each of them has enough room to grow as well as create value for all its shareholders. So we've been actually quite pleased with the way things have evolved over the last few years.
Vasu, you're on the other side of the ecosystem in a sense, right? As a fintech who's scaled, mature, right? And you're almost mentoring many of the younger founders as well in your role. So as you've seen this, right, so the calibration of compliance, the focus on innovation versus compliance versus governance, how are you seeing that evolve in the minds of founders?
I think Rajiv has spoken of the collaborative approach between banks and fintech, so I will not dwell further on that. But the hardest thing about fintech, I think, has been to define what is fintech and to kind of ring fence what comes under it. It's evolved over the years. I mean, you've had, if you would think of the terms, there was payment tech, there's credit tech, there's reg tech, there's soup tech, and somewhere the catch-all phrase became fintech in terms of what all it covers. It's also been a convenient term from a market addressable perspective in a global sense as to how do you attract funding, to how do you build companies, how do you communicate with what space you're operating in. And people have built businesses there, I'm talking from the companies and the founders' perspective, because they did see an opportunity of playing a role in that space. But in terms of the maturity curve of what has triggered, if I were to pick on a couple of things, I think the couple of defining moments, if I were to put it that way, was RBI creating a separate fintech department, sometime in 2022. That kind of then carves out a space and says there is a space. Having said that, it is still challenged by the fact saying what all comes under this space, right? So a large tech company providing a banking solution to a bank, a technology solution, does it come under that? Those are debates that are still open, but I think that was the first one key definition as to the fact that you're a separate department. And as Rajiv mentioned, it has evolved. The sector and players have evolved a lot. Multiple factors, but picking up a couple of you, I think the regulatory nudge has been there to, the regulators engaged very proactively. RBI has done many sessions, right? Understanding A, the need, B, the role that the businesses play, but kind of also bringing to the fore saying these are enterprises that connect to banking systems and customers, therefore the way to behave responsibly. And I think industry has reacted very well in terms of how they're building from there. The second thing that accelerates maturity in any situation for any sector is funding scarcity. It very quickly gets you to build businesses the right way. So I think that's the second trigger that is happening here. So I think it's going well, maturing well, and I do think two other events are left, if I can think of it as milestones. One is the founders building businesses to sit back and say, okay, I started business building a certain way, thinking of it in a certain manner. I understand now that I'm in a regulated space, and therefore having a vision for the next, let's say, 5 years to say, is this what I want to be doing? Is this what I set out to build? I think that's one round of soul searching that is left for the industry as a whole. And flowing therefrom the rejigging of the organization culture, as I would speak of it, to say, need to prioritize these things. Because that is a big shift. When you're building something from a platform innovation perspective, then to move into a space saying, this is a regulated space, so I have to bring in a certain balance between that innovation, that governance aspect and compliance. It changes an organization. I think those two steps are still left.
Nupur, coming to you, you sit almost in between the incumbents and the fintechs as you are taking them along a journey of innovation at national scale. So and as you've seen the different fintechs and incumbents participate in this, how have you seen both sides evolve? Right? What has changed?
Sure. Thanks, Vivek, for asking the question. See, where banks are concerned, I think regulation and compliance has been in the DNA forever. So that's not something new for the banks, but for fintechs, it has been an evolution over the last 2 decades. Let me split this into the B2B fintechs and B2C fintechs, right? Where the B2C fintechs are concerned, their primary excitement came from user experience, from putting out very niche products and playing in very gray spaces, if I may say so, or so on and so forth. For them, compliance was a side function which they did not focus on or did not spend on for the longest time. But over the last 5-6 years, they realized that that is not a sustainable way of doing business. Banks have been focusing on compliance for a reason. And thankfully, most of the fintechs have realized that it is core for their operations and sustainability. So, the B2B fintechs were the first ones to go back to the bank saying, yes, so far we've been working only as a technology provider to you. and we've been the best at that, but now we can collaborate with you on aspects of compliance and risk as well. On the B2C side, again, I think regulatory compliance is now becoming core to them. And in the product design itself, they're thinking fraud, they're thinking cybersecurity, data protection, so on and so forth. So the mindset shift has been phenomenal from where I've seen it. And finally, there's an entirely new set of fintechs that have emerged that are saying that we will give you the risk solutions, the cybersecurity and data protection solutions, and they're going to fintechs and banks alike and supporting them on the back of new age technologies. So a big shift over the last 2 decades from where I sit.
Anubhata, in your role, you've taken this innovation to a lot of the segments which are today underserved, right? I wouldn't say necessarily only in the semi-urban areas, but you've touched a lot of that. You've also moved into the urban areas. As you look at this whole topic of compliance, innovation, etc., does compliance and start coming into the cost of serving, right? And therefore, does it in any form start becoming a hindrance to innovation?
So very quickly, I'd like to first point out the maybe slightly misplaced logic. Am I audible? Is it better? Yeah. Okay. So first, a slightly misplaced logic between fintech and tech. I probably oft repeated, but I'd just like to paint it with some couple of data points globally. First, for fintech platforms or regulated platforms to scale and really hit the tipping point of scale, globally it's taken 7 years. So you look at Brazil, you look at UK, a regulated platform which balances both prudential risk and consumer outcomes needs time to build, and traditional venture capital doesn't really understand that because the venture capital cycle is fundamentally driven in a 3-year to 3-year cycle. So the demand for a fintech platform to scale similar to an e-com platform from a global capital point of view is very, very strong. And that's what's actually driven this mismatch in expectations. It's played out in India, and therefore I would like to just paint out the example of Airtel Payments Bank. Broadly, 7 years in history. And today we are at scale, around 90 million monthly users, roughly around 2,800 crores of ARR profitable. We process around $40–45 billion of annualized payments. So it's a company at scale. The simple 2 points are it's taken those 7 years to build because we factored into the regulations, but most importantly, cost of compliance, if I just look at operating expenses, is 15% of our P&L, but revenues, which are regulated, are 40%, which means core banking account revenue is 40% of revenues, while 15% is compliance cost. So the trade-off when you reach that tipping point of scale becomes very, very profitable because it becomes a deep defense. It becomes a tough moat for the other companies to enter. And that's why the belief and the marriage of innovation and compliance is really that scale is well built when you build it compliance first.
Adil, you've built a business around digital, and as we speak about evolution, evolution has not just been in fintechs and incumbents, but also in regulations and guidelines around us, right? So, and that's a space where guidelines quickly evolved actually in the last few years and to some stability now. So as that happened, how did you see the reactions around us, the responses? We did see a few fintechs fall away along the way as regulations evolved. How should the ecosystem prepare for something like this, and how do you see that playing out?
Absolutely. So I want to, am I audible? Thank you. So I want to start off with what Rajiv said, right? Saying that the priority that compliance gets is much higher. And I think one best practice a lot of fintechs can follow is partner closely with a bank which is great at compliance. So, RBL Bank is one of our great partners.
And at every stage, we work with the bank to make sure that it's bank-grade compliance, which I think really helps, at least on the B2C fintech side, which Bank Bazaar has seen. I think fintechs have gotten very organized, Vivek. So FICCI has a great fintech committee. Now RBI has created an SRO called FACE. RBI is meeting with the fintechs every month. And we have an open discussion saying this is our thought, this is ULI, what is the input. In fact, before the digital lending guidelines came out, the draft was discussed. We gave feedback, the feedback was discussed, and then the final guidelines came out. I would really want to appreciate some of the thought process in the ministries, right, wherein there's a new Digital India Act coming out. They came to us for pre-consultations. It happened in Bombay. This was not even the draft law, but a pre-consultation with a deck saying, here are the 6 chapters. AI is one of the chapter. Here is what we're thinking. What do you feel about it? So I think consultation has increased dramatically. But what fintechs are also realizing is that our business now touches many regulators. So our relationship with the RBI is much strengthened by the monthly meetings. But now we've got to start engaging with TRAI. We need to start engaging with ministries which might not be directly fintech, but are making rules around communication which are core to the fintech operations. So it's a rapidly evolving situation, and I think talking and deep consultation is the best way to iterate through this.
Krishna, coming to you on the data side, I mean, given you're from Perfios, I'll probably swing the data question to you, the obvious one. Compliance around data is even more complicated, right? And this has been an issue of interpretation in many places, issue of gray in many places. We know there's the act that's around the corner, right, to make it more streamlined, more clearer, and probably just make it simpler for people to know what to do and what not to do, right? How do you see that affecting what's happening today? Will it impact some of the existing models of business directly, right? How will people have to adjust? Are people preparing themselves well enough from your vantage point?
Thanks for that. Am I audible? Okay, brilliant. Okay, let me take the Perfios perspective first, and then I'll go into a little bit more generic aspect of DPDP. At Perfios, we don't store data. So as far as Perfios is concerned and its regulated entity consumers are concerned, there's a lot of clauses of DPDP which are already taken care of. However, this question goes much beyond that. It's about ensuring that the customer who's providing the data is providing for the reason which he intends to provide the data for, and it is used as long as that intention is kept. Now, that part of it is where the complexity begins. I'll take 3 points to that. Let's talk about the first part, which is probably the easiest, which is consent management. I say easiest because the next 2 are probably much more challenging. Where will you take the consent of the customer? How will you frame that consent to be comprehensive enough? And how will you ensure that the consent is taken away the moment that particular use case is removed within the flow of that particular bank or of that particular current account opening and so on and so forth? How will you do that? That is consent management architecture. And that is something which we are working along with our regulated partners to create. But that is probably the least of the challenge. The second challenge, and I would put it in a different way, I would say that regulated entities need to have something like an angiogram of data. When I say angiogram of data, what I mean is the moment the data first is collected from the customer, it does not reside only in the application. From the application, it goes into multiple systems across third parties. Where is this data residing and how it is currently used? Creating that map, or as I call it, an angiogram, is super critical for every regulated entity. And that creation is something which will help them understand how to retroactively implement DPDP once it comes into law. Because the customers will remain the same. They will come back and they will be empowered to take back the permissions which they have given. Now comes to the last point, which I believe is one of the biggest challenges. It's about cross-sell. We all know how critical cross-sell is to all our businesses. let me take a different example and probably try to explain it from a different industry. Most of us have Apple iPhones, and when we download a particular app, there's a permission which comes up which says, allow the app to track. Allow this app to track me across websites, search history, so on and so forth. Now, some people give that permission and some people refuse that permission, right? That power is in the hands of the customer. For example, take my example. I willingly gave that permission to Instagram. Why did I give that permission? Because it gave me value in terms of related understanding of my needs immediately the moment I gave that permission. That immediacy and that relative value is going to be super critical for all our financial services industry to provide, because that will make it worthy for the customer to give that permission to us. And that, I think, is probably the biggest challenge we all face as financial services.
Rajiv, coming back to you, spoke about the collaboration piece, right? So, and it's been many years now. We almost assume that the playbook is kind of now set in terms of where a fintech comes, they know how to approach a bank knows how to approach a fintech. But is that completely true? Are there still a lot of unknowns that are being discovered, or are we in a steady state where it's just easier for some of the newer players to follow the path of what the preceders have set?
So, Vivek, I think the playbook is a lot more understood across. So, I mean, 6-7 years ago, this playbook was not even in the realm of thinking. Even as banks, we were not fully kind of sensitive to this. Today, we have a checklist. We lay it out in front of a partner. And when Adil and we joined about 3.5 years ago, it was clear. And as rules have evolved, we've also shaped our offerings to the customer to look at the rules. I think the principles of collaboration are very clear that, customer service, customer data, customer protection, is the key. And then I think the other thing which we've seen drop off quite sharply is the arbitrage which many companies coming into financial services felt was an opportunity. I think that's reduced, almost gone. I think that becomes easier. Now, I think the trick is, how do you take this new learning and a customer who's looking at newer services at better price points, and for banks of our size, we will never be able to figure out every corner of the market. We partner with Adil on, consumer finance and consumer cards. We partner with many others in B2B spaces. For a bank of our size, we are very keen to actually take on partners who can expand our reach, okay, where we can marry our services and products with theirs. We are one of the larger payment infrastructure providers at the back end. So some of the largest consumer payments, B2B payments, would go through our core. Our endeavor is to provide a consistent service to the fintech's consumers. So I think the trick now is to figure out, where does the collaboration lead you to? Does each party have the stamina from a market perspective, as well as increasing levels of compliance which will be required? I think those are the things we are not debating. I'm very happy to say that what started out for us as Let a Thousand Flowers Bloom, almost 10 years ago, we published an advert because we felt that that was our coming out as a young bank, Partners Ka Bank. I see many of these partners. Obviously, many names have changed. Some have not gone through the distance. We still have that and many more partners who've succeeded. And some of them are now, public companies, and some of them are now soon to be public companies. So I think the opportunity is large. The swim lanes, as people say, are clearer. You have to now figure out what suits you as a fintech and what suits you as a bank, and then have a deep discussion on where this can go over a 3, 5, 7-year perspective. Because I think the opportunity is massive, and we certainly believe that a mid-sized bank needs these partnerships to be able to scale up. And I think, what Anubrata is doing, we certainly can't do that. the DNA they've created on the back of a telecom company. That's, I mean, we can't replicate that, but we are very happy to provide the back end for many of us similar service providers. So I think these are things which are more clear now for many of us, and that makes it quite exciting.
Nupur, you have introduced a lot of new players into the world of payments, and Rajiv spoke about B2B. At GFF, you launched a product where we saw a lot of logos which you don't generally associate with payments coming onto that network, right? So you have a lot of these ERPs or new platforms which are going to start plugging in to a payment platform. Now, this also comes into question, are they fintechs or not? I mean, many of you touched upon the definition of fintech, but at the end of the day, they're all going to operate in a space which is regulated, in an area which is regulated. As they come in, how are you seeing them engage around the topic of compliance, regulation? Are they coming in prepared? Are they coming in and getting caught by surprise?
Vivek? Yeah, thanks for asking me the question, Vivek. If I may start with probably 2 data points, possibly not related, but around 2015, when RBI opened up the payment banking licenses, there were around 12 or 13 entities that applied for that license. More recently, when RBI opened up for payment aggregator licenses, there were 120 plus entities that applied for the licenses. And if I be honest, when I talked to a number of them, they had no plans or models around how they would leverage that license. And yet, the entities wanted to be regulated, right? I think there's been a marked shift in the fintechs. The thought process is that I have to take care of the governance, the compliance, equally so as a regulated entity. That 15% cost that Rajiv alluded to is a given and is a cost of doing business now. So I'd rather be regulated and be close to the regulator than otherwise. So one, there has been a shift in wanting to be regulated. The second, equally so, is that they've realized that the reason the customers trusted banks and continue to trust banks was because they were regulated entities. By, therefore, becoming regulated, the fintechs now enjoy trust, not just from the customers, but also from their investors. And it is a good segue into public access if they choose to become listed tomorrow. So I'm seeing, entities, whether they're ERP, Zoho has got a PA license, and a lot of other such entities are wanting to be closer to the regulations. And those who are not able to do it immediately, they are finding ways of working with regulated entities and getting an equivalent comfort. So in our system alone, most of the PAs and regulators have been kind enough to make the PA license interoperable. So everyone who is a holder of a bank license or a PA license can become an operating unit on our system, which is Bharat Connect now, without any incremental paperwork with the regulator. So regulator also wants to encourage more regulated entities, but outside of that, we have more than 500 agent institutions. These are companies who do not own a regulatory license today, but they're keen, and they're keen to work alongside regulated entities and entities like NPCI and ourselves, so that they have a shield or a cover and not taken in by surprises that we have seen or disruptions we have seen over the last couple of years. So clearly a marked shift in that direction.
Interesting. We've heard a couple of times in this conversation that the regulatory arbitrage is no longer that big a deal, right? And we're also hearing a lot of willingness to be regulated. And Anubhata, as you look at this story play out, right? And whenever we talk about risk and compliance, generally the thought goes to the asset side or the payment side, right? But risk and compliance is as much when it comes to any liabilities business or anything related to financial services all over the place. With the evolution and the maturity coming in, now is there an opportunity to also start seeing that compliance can actually become a differentiator, and therefore can people start building differentiated models by just knowing how to work within the compliance guardrails a lot better?
So the short answer is yes. But let me couch it with some examples of what's happening in India today. Ultimately, compliance is about only two factors: prudential risk and consumer protection. Let me take consumer protection and give an example of what's happening in the consumer mind space today. With the frictionless digital public infrastructure which has really taken shape in India, there's been an increasing concern on digital frauds. And what we see is that our consumers are flocking to us because they want a safe second account, safe, determined by the fact that we are regulated. It's a 2 lakh limit account, money kept aside from their main bank, and therefore second. And they want to make their digital payments only through an Airtel payment bank account, simplicity of account narrations and all of that, but most importantly, because the main bulk of their wealth, they don't want exposed to the digital ecosystem at all. This is now population scale. Just to give you a context on this, we are opening over 1 million accounts a month. Financial inclusion accounts and what we would call digital financial inclusion accounts. And the traction in terms of usage has made us the 6th largest bank in mobile banking in the country today. That just gives you a sense of how seamless public infrastructure can give rise to consumer protection needs. But as banks are maturing, I see it as a 3-layer architecture. You build a compliance-first architecture. You do the right things. You do KYC, you do AML, and so on and so forth. How do you use the first layer architecture to then start being a little ahead of the curve? So I can tell you, for example, we are still not using AI. In the purest sense of the word, we don't use large language models yet. Obviously, we want to be very sure of where the data is, whether the LLM model is actually in the US or whether it's on-prem in India. But ML, we use in a very large way for detecting mule accounts before even a police complaint or a transaction gets originated. And I'm very happy to share that we are actually able to catch an extremely large proportion of mule accounts before even a police complaint comes to us. That's the second level, where you start using technology to get better and ahead of the curve. But then the third level is we asked ourselves, look, if you've already tried to identify that an account is suspicious of either takeover or handover, can you throw open that access to the customer? And we've launched this product called Face Match, where we are actually able to throw it open to the customer to match his face on camera with our picture on records if he or we believe there's the slightest suspicion of trust. And that's what I call the third layer, moving ahead of the curve to really offer differentiation. And I think these 3 layers work very seamlessly together.
I think one of the topics that's clearly evident is readiness, compliance, governance, and access to the regulator that was touched upon, how RBI has opened up a fintech department. There's a lot of interaction that Adil, you also talked about, Vasu also touched upon. Now, you briefly touched upon this, Adil, but there is now a SRO that has been announced. The first fintech SRO has been announced. We'll probably see 1 or 2 more depending on how it goes. But what's the role that we expect these SROs to play now? And in a way, if I may ask this, will it cause more clarity? Or with one more player coming into the mix, is this going to be a little bit more confusion before things settle down?
Right. So the fintech SRO is very important, and I'll explain why. So for a consumer fintech like Bank Bazaar, right, the value, and many others like us, the value we offer a bank is we're saying we'll bring new consumer expansion because we have these consumer bases, and we'll deliver a great customer experience. So our consumer will be able to do this frictionless, seamlessly on our app. But for the core, we'll partner with Rajiv or we'll partner with Sanjay, and they will manage the compliance. Now, to have a seamless experience, you need a level playing field. So I think the SRO is very, very important, right? And one of the first things I feel is a level playing field wherein today we have all this great digital public infra in India. We have account aggregator, we have ULI, we have DigiLocker. If the fintech is managing the consumer front end and needs a seamless experience, should it not have, if it's credible and registered with the SRO, equal access to manage that data securely? And what we're finding is, look at technology which has scaled in India, UPI, where the world's darling, right? But it's because the banks and the fintechs came together and each excelled. So if we're going to do the same thing with ULI, how do we create an ecosystem where the fintechs and the banks can play to their strengths, but at the end of the day, India wins, right? And I think that level playing field is something that all the fintechs need to organize and make a credible case for.
Vasu, do you think the SROs would be able to actually bring that together? I mean, I think it's a fair point that Adil makes, that level playing field would definitely help, but the regulator has been reaching out, right, has been talking to the fintechs, has been trying to do whatever is feasible. The regulator has also been talking about how fintechs, not all of them are regulated, right? If you have a license, you're regulated. Otherwise, you're working with a regulated entity, and through that regulated entity, the fintech's governance and rules mechanism is working out. With the SRO coming in, will that really change the space and take us where, Adil's saying that it'll probably or hopefully get us to a level playing field? Will that mean that as a fintech, you should necessarily get registered with an SRO to get to that place?
First of all, within, let's say, financial services of fintech, there aren't too many existing models world over of SROs having been built to scale and working. If we managed as India to pull this off, I think it'll be a first anywhere. I can equally see the challenges, like Adil has pointed out some of the advantages that might come out of it. I can equally see challenges in building one and getting to the desired end place. Right? So, to begin with, some of the points that you alluded to, how do multiple SROs function within the same domain is going to be one challenge to overcome. How do participants decide which SRO to participate in, especially where it is optional and not mandatory thing to the point that you raised. But lastly, I think the main question becomes, what's the benefit of being a member of SRO versus what are the downsides, right? Those are things that will emerge, and I think, to be fair to the ecosystem at large, because it's the first time, these things will evolve. We already have a paper on SRO for payments, which is different going to be from SRO for fintech. There'll be multiple SROs within fintech, and so I do think it's a model that yet to evolve. It's also a question of how it's partially playing part of the regulator's role there, right? It's a carve out of what things that would normally in the current context have to be done by RBI, but passing on here. And if these are bodies that focus only on standards and guidelines, is one way, kind of you bringing about discipline in an informal manner. I do disagree with the construct of a level playing field, because it's a larger topic discussion. Level playing field for what is a topic I would think of. If out of a level playing field between, in a context, if one thinks of it as the bank versus non-bank, then SRO needs participation of both constituents. If SROs are a function of only fintechs, which are non-banks, then it's a question of that SRO negotiating another SRO that represents banks to say what should be the level playing field. So maybe it's one common body instead of multiple voices. But from a marketplace perspective, I generally think if you're building businesses, you sometimes let market forces play. When you tend to commoditize everything into one thing, it actually perhaps reduces optionalities, right? So there's a role for SRO. I don't think it's carved out yet of specifically what all the broad omnibus framework is there, but I think it's yet to play out.
Rajiv, from a banker's point of view, so for example, if an entity is registered with an SRO and not registered with an SRO, right, would you look at them differently, and what would you do differently?
So yeah, I think, and I'll just give our experience of MFIN, which is one of the first SROs now, almost 10, 12 years, started after the AP crisis. There was a catalyst for that. I think over the years that has become, obviously I think there were 2 SROs and, still, it becomes a conduit for sharing experiences, putting some protocols, and also having a effective conversation with the regulator. And the regulator then deals with it, expects certain responsibility via the SRO on its members. And we've always been first an associate member, because that was largely NBFC, MFIs, and now we are a full member. I think it's served us well, because, microfinance was a evolving theme, a lot of consumer issues around there. So I think similarly, we would feel, and I've actually offered to be part of the SRO as us, because, ultimately you have to expand the offerings for the customers, and you'd rather have people who actually are inclined to conduct their behaviors in a responsible manner and advance the cause for, becoming better and better over time. I'm not saying we will not deal with people outside the SRO, but eventually I think the SRO becomes meaningful, and all of us have to contribute to the SRO becoming meaningful. I think it'll become an effective voice. And I do also think that India's followed a very different approach to some of these business model innovations. I mean, the fact that NPCI and Nupur is here, which is actually developing a lot of protocols and applications which everybody can use. I mean, imagine if they were not there, we would not be sitting here discussing fintech, to be honest. So one has to take these, that in India, the cost of innovation, the time spent in getting people to come into a compliant network is not worth it if we have to expand the reach of financial services to the end consumer, whom traditional providers have not been able to do because of their own cost structures or approaches. So I think being part of the SRO lifts the standards. It doesn't mean outside of that is all bad or inside of that is all good, but it just puts some boundary conditions for all of us to work in. And for the regulator also becomes more efficient to work with the SROs if there are more than one.
I think as we were speaking of SROs, the topic of our DPIs and so the infrastructure came up in the conversation. So I'll just touch upon that a little bit. Obviously, it is a crown jewel that's been spoken about a lot, the DPI stack that we have, about how it's fostered adoption, accelerated, etc. But is there also an interplay of how much DPI versus how much custom innovation? What's the right balance as we go ahead, right? I mean, Vasu, maybe if we get you to start us off on that topic.
Again, it's in India first, right? I mean, DPI is a generic term, but India has made it a national agenda. So in some sense, to the point Rajiv alluded to, when you come up with a construct which defines, let's say, a boundary framework, and in this case, it is to say DPI is national infrastructure, national agenda, a certain set of rules are set, right? And it will shape the market differently from a market where DPI is not national agenda. I think that's one takeaway. Which way will it head is a different issue. Does it, for a country like India, I think the advantages of a national agenda on DPI has a very clear benefit and end purpose in the way it's envisaged. Things like this succeed where the policy view on that is very strong, and ability to enforce implementation is very strong. There are two necessary conditions for these to work. In the current construct, India is in a position to get all these done, right? Whether it's a DPPP Act or you find its implementation, enforce it down across, let's say, multiple regulators to multiple terrains, that exists, and therefore it plays out a certain way. So on that front, I think it's all good and all pluses. If you kind of move away from that to say, what does it do from any other perspective, and let's just take a perspective of markets to consumers, the benefits are all there, right? I mean, that will all be spoken of. Nobody will dispute that it leads to a better thing. If you were to focus on what can it take away from, at scale, it starts defining pace of innovation. I wouldn't say restrict or accelerate, it starts defining it, right? Because now multiple players can be there, and we, in some sense, seeing how fintech impacted banks, the pace of innovation. I think DPI and common platforms, unified platforms, single platforms tend to define, they can accelerate in the initial stages. At some point, it can need a refresh, but I think they define the pace of innovation that can happen. It will also, to my mind, and it plays out over 5-10 years, reduce market to the two ways it can work. Few set of large players, or a diversified set of multiple players, and it really doesn't impact kind of who stays, who goes.
Nupur, you've been part of building some of these national infrastructures, and obviously we've all seen the benefit of how it's democratized and brought in a lot more players into the mix. But do you also see this tone from maybe some pockets who are saying, hey, we're already doing some of this, this will hurt what we're doing in our core business? How does that play out?
Yeah, Vivek, that is a very live conversation. Last week, GFF, a lot of such side conversations happened around, if DPIs are doing more than their mandate, will it start hurting innovation for fintechs or banks, etc. But the parallel I would want to draw, it is called infrastructure for a reason, right? What we are doing is laying down, rail tracks, laying down roadways, building bridges, and possibly building a few traffic lights on the way. But innovation is what goes above that road. Whether it is a hybrid car, EV, a three-wheeler, or an Ola scooter, that I think is what customer touches, and that is innovation. So we're just making it a level playing field on which innovations can be built. If I talk about UPI, we thought, the way of payment is standardized, the QRs are standardized, nothing more can happen, and then suddenly a soundbox happens, right? So when banks and fintechs alive are not doing basic hygiene, I've been a banker 20 years back, and a lot of time got spent into just solving for KYC. And now with Aadhaar, KYC has become, just a couple of minutes affair. So when the hygiene goes away, the same set of product folks, technology, availability can be used for innovation. So I am of the firm believer that we are just helping with the base infrastructure for the hygiene, which wasted time, thus making and paving way for a lot more innovation to happen. So that's how I look at it.
Krishna, you come from a company which probably lived this, right? I mean, you guys were in the space of data banks. If I just take the example of bank statements to make the case, right? You had created the extraction as well as the analysis part of it. The extraction got standardized with the AA coming into the play, right? So how did it play out for you guys?
Can you hear me? Am I audible? Okay, brilliant. So if I look at DPI, as ma'am rightly put, the infrastructure or the roads are created, right? What is driven on that road is something which fintechs and financial services will build. And when I come to Perfios, Perfios has many parts of it. One part of it is to say that how do I get the data? But that is the base, or that is the foundation. The second part of it is the triangulation of the data. That means, am I getting the same data from multiple sources so that I could ensure that the fraud is not committed, identity is not muddled, mule accounts are not active, and so on and so forth. So that is a triangulation aspect of it. After that, one level higher comes the extraction and tabulation. just to understand today, even today, scanned documents are some things which are still used, even though AI is something which is very, very fastly being taken up by all the banks and fintechs. Even now, we see a huge amount of scanned documents coming in. How do you ensure that without wasting a huge amount of operational bandwidth, using machine learning, you can ensure that the right data is pulled out and tabulated? That is innovation. Then comes the next part, which is the analytics part of it. How do you utilize that entire data to create meaningful insights for our financial services, for the financial services company, which they can basically take and utilize for credit underwriting, utilize for fraud prevention, utilize for risk management, utilize as early warning signals, and so on and so forth. I think as long as the DNA of the company is clear that compliance is paramount and innovation is continuous, regardless of and DPI will only be a fuel or a fuel to the rocket ship rather than a hindrance. It will, in fact, be one of the best things which has happened to any fintech in this country if DPI democratizes the access of data. Last example I'll just talk about, the land records data which ULI is going to provide. That is going to revolutionize the entire agri-loan sector. Milk production data which is going to come in, that is going to revolutionize how we lend to MSMEs and small farmers. Digitization of that is probably the real victory of fintechs.
All right. So in the interest of time, I'll also probably open this up to the audience in case there are any questions that are there for the panelists on this topic. You can see a hand go up there. Is there a mic?
Good morning. Thank you, panelists, for wonderful session. My name is Sanjeev Verma. I'm a banker for last 30 years plus. Most of the time into retail assets, mortgage finance. I've seen many cycles. Adil, if you could recollect, we were there in Ratnagar Bank. Rajiv sir guided me on some lead generation process in 2014, right? So from there, we believe in 3 C's. One is the customer, the capabilities or capacities of the customer. And third is obviously the collateral. The first 2 is sorted, right? The third one, which is the collateral, is still the bigger issue where we see first documents, etc., etc. So what is your views, Adil or maybe Krishna? Because we are working hard, but still now I'm managing, smaller towns where collateral is again a bigger issue and the manual khata or the manual transactions are still happening. So last 10, 15 years, we're listening. So any views into this? This is my first query to maybe Krishna and Adil can help me. Second query maybe with Mr. Anubrata, if you can help me because in the new role, so I worked with ICICI, Citi, RBL, Yes, and Axis, and now with this smaller MSME company, where we are targeting tier 4, tier 5 towns, we are giving secured loans. But still the challenge is, we are into financial inclusions, female preferred financial company. And also, we are talking about our advisory services, how we can add more values to those smaller customers while advising them. The challenge which we face in that market segment is the cash collection. So we have 14,000 customers. Out of 14,000 customers, still 30% believe we would come and collect the EMI on cash basis. So we are trying and educating them. So these are the 2 things which, if you can guide us, watch because you are part of many panel discussions, etc. So if you can highlight some of the first query maybe with Adil or Krishna, and second Anubrata, if you can help me. Thank you.
I can certainly try. So Nupur and Rajiv spoke about how we've done a great job with DPI around KYC, around payment. To give an example, with video KYC, which is a DPI today, a bank officer can do KYC for 2,000 locations. Sitting in Mumbai, you can securely do the Aadhaar, the CKYC, the video KYC, and productivity has gone up 10x, right? It's incredible. But the next stage of DPI is going to be data, because credit is very different from payment. All of us, if we were to pay you 100 rupees, the transaction is the same. But if we were to lend you 100 rupees, each of us would think of it differently, and that we need data. So Gen 2 digital public goods, which is account aggregator, ULI, that's going to really change our ability to have data on you. So I think the question now is, can we use flow-based data rather than collateral? That's question number one. Question number two, can that data be made electronically available via what ULI is talking about? So for me, the opportunity is the Gen 2 DPI. And the Gen 2 DPI is all about bringing data to the lenders so they can take the complex underwriting decision that they need to take.
Anupata, maybe you want to take the second question.
So I'm sorry, which bank are you?
Hi, Anurta, this is Sanjeev Verma. Right now I'm heading an MSME registered NBFC company called IREP. I'm the deputy CEO there. So we are funding smaller MSME customers.
Yeah.
So we have almost 100 branches now. And the cash collection is the biggest issue. We wanted to, we are educating them, but still 30% of the customers still believe we need to come and collect. So how we can collaborate, how we can do it together so that we can have the banking in place and they can start paying through NASH, etc. That's a challenge which we are facing. If you can, guide on this part.
So I can give you some stats. We are the largest micro cash collection player in India. We process over $1 billion of cash every month. 250 MFI, NBFC, e-com logistic companies use us to collect cash at point, which is really that agents or customers come to our over 450,000 banking points and drop off the cash, and we seamlessly credit it instantly into the client account. So I'll end by saying that we'll probably meet just outside this room and we'll exchange cards.
We probably have time for one more question.
No, Krishna, my query was regarding the collateral risk. If you kindly, what is the updation there? Are we, because some part of the country only we are managing that, the collateral through e-agreement, etc., the verification is possible. But still 70% of the country is still struggling, going into digital way the collateral management is. So anything happening into this, any new development, or where are we? If you kindly guide us for the way forward, would be really nice.
I think Adil had probably answered that very, very clearly in terms of the fact that TPI 2.0 is exactly what is going to take care of that. I believe MP and Rajasthan are two states where the lot of digitization has already happened in terms of land records. The moment the land record digitization happens, the next level of that is what is the valuation of that particular land and what percentage of that can be collateraled and so on and so forth. Let's take a little bit of a separate example. I'll go a little bit differently from the land record part, agriculture, right? DPI 2.0 is not just going to give you land record information, it is going to give you crop-related information, it's going to give you satellite-driven exact land parcel size information, it's going to give you land moisture information, it's going to give you irrigation patterns, last 6 years of the crop which have been put, the crop in relation to the surrounding crops, the seasonality of the crop, and so on and so forth. Just imagine how much underwriting you can do with this, but having said that, this is a journey, right? The data for people like us who are, probably you would have understood by now, who are data fanatics, it is a dream when you seek this kind of data to collateralize. But this data creation is something which DPI 2.0 is doing the hard work of digitizing and providing to us. So I think that at the end of the day is the dream.
Thanks, Krishna. One last question. Yeah.
Hi. This is Gaurav from Hyperverge. My question is to the entire panel, but I think more specific to Krishna and the other bankers. I think we spoke about, I think Krishna was speaking about consent in a bit, right? You spoke about consent should be comprehensive, and then I think other panelists were also discussing about the importance of cross-sell for businesses in general, right? However, if you see how consent is defined in DPI and other global consent-related regulation, consent has to be specific, unambiguous, unconditional, right? If you see these two things, then there is a slight conflict between these two thought processes, consent being comprehensive and consent being unconditional. How do we balance these things from bank's perspective? Because if you make it comprehensive from the perspective of, and you want an ability to reach out to customer to cross-sell multiple things, then it is not balancing those things. Because the customer, because he wanted to avail a particular service, you took an unconditional, comprehensive consent for a lot more things. Do you see a conflict here? I see a conflict, but do panelists see a conflict here? And how do we balance this kind of conflict in the interest of customer centricity also?
Rajiv, maybe if you want to start as a banker in the panel.
Yeah, so we've taken the more conservative one. So we explicitly ask, whether you will agree for us to, outside of the regulatory communication, to talk to you about X, Y, Z. So we believe that as a bank, we need to kind of take the more conservative route rather than do a implicit unless you object. And I think the next thing is to review that frequency-wise because things change. I would also say that next would be, I don't want to be called for ABC, but X, Y, Z you can. Those would become more, and as Krishna said, context-based. So I think those things are evolving, but as bankers, we've decided to take a conservative view on the kind of consent we seek.
So I want to just share a very interesting trend we're seeing. It's started happening with TRAI, with DLT, and now the DPDP talks about consent manager. And what's happening is consent is being collected as a digital public good. So you have to go to a certain platform, give your OTP in that platform, and that platform will say you consented to work with Bank A or FinTech B. So there's a new concept of consent manager coming in, wherein even the consent management is becoming a digital public infra. It's really interesting. I think we'll see it evolve over the coming quarters.
Thank you so much. I think it's been a fantastic discussion. Thank you to all the panelists. It's quite evident that the ecosystem is mature, right? Evolved, and there's a lot more to come. So exciting times ahead as we see this balance between innovation, compliance, fintechs, incumbents, infrastructure come together and play out. Thank you so much.
Thank you all dignitaries. Ladies and gentlemen, we will take 5 minutes to reset the dais for the next session.